Normally, you're supposed to get one unicorn out of every 20 startups. The key thing here is the paradox from the VC perspective. Your best winners, your unicorns that are growing quickly, they don't need much of your help because within 1 year to 2 years, they raise money from a larger fund, they get more help. Everybody likes a winner, or the best employees want to join a company that's doing well, right? So your best winners tend to require not much help. The people who are struggling the most, doing very badly, need the most help.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
The economics of what the VC funds are doing. When VCs have sourced and selected the companies they want to do, then they have to make a decision about whether they want to add value or manage a portfolio. Adding value is the sexiest part. Board work, strategy, compliance, hiring, do connections. So somebody was asking earlier about how do you differentiate as a VC fund. So you add value. You should pick me because I'm a VC fund that adds a lot of value. A lot of VC funds made 20 investments and say, we thought all of them were going to be home runs. But after 1 year, half of them, I don't want to spend time with anymore because I want to prioritize my time on the remaining 50%. I want to reevaluate those on-track versus off-track versus home runs. I have a limited amount of time, resources. So it's not one or the other, but mixture of both. For example, if you go to a VC fund, I know of this startup, they're not doing well, and the VC fund is supposed to be on the board. So they have a quarterly board meeting, but the VC is never there. The VC no longer cares about the company because the VC doesn't think the company is doing well. But of course, there are famous stories where suddenly this company is not doing well for 1 year, then suddenly the founders figures it out, then suddenly the VC pops back up and says, okay, you are back on track, now I'm going to pay more attention. So there's a yin and yang where you're adding value, but you're also judging and pruning your portfolio. VCs are thinking, should I prioritize home runs? Should I support them? Should I dedicate the support work to somebody else? Or should I just ghost and not do any more work with that time? For example, one way that they could potentially score the portfolio out of 100 companies, let's say across 3 funds, right? Let's make it simplify that. So let's say you are a VC fund and you have 5 VC funds, each of them has 20 companies each. So you've invested in 100 companies. Let's categorize them into expectations. After a while, you're like 50% is loss, goes to zero. 25%, I'll get $1 for every dollar I put in. Small win, I'll get 10%. Large win is maybe I get 100% return. And a unicorn is I get 10 to 100x reward profile, right? So obviously definitions can be loose as well. Differing funds, differing definitions of what. But people always think, which one should I do? Look at the outcomes. If 2% of your company is unicorns, your return profile is 2.42 for every dollar you put in. So you get 240% after this time period. Normally, you're supposed to get one unicorn out of every 20 startups. The key thing here is the paradox from the VC perspective. Your best winners, your unicorns that are growing quickly, they don't need much of your help because within 1 year to 2 years, they raise money from a larger fund, they get more help. Everybody likes a winner, or the best employees want to join a company that's doing well, right? So your best winners tend to require not much help. The people who are struggling the most, doing very badly, need the most help. There's actually a bit of a contradiction that's there. VCs have to make that judgment call about which startups they actually can make a difference in. But every round, when the next investment round comes in, the VC can make a decision about whether to double down and put more money into the company. They make double the investment, double down. They can prorata, means I can maintain the ownership stake that I roughly have, or skip, which is I don't want to invest in it. This chart shows the Instacart IPO. The card came out on the public markets a few years ago. And this chart shows all of the funding rounds they achieved. So we talked about it previously, right? C, Series A, B, C, D, E, F, G, H, I, IPO. This shows the year 2012 to 2021 plus. Equity pricing shows roughly what is the value of the stock they had. One stock was worth $35 back in 2012. When they IPO'd, the price per stock was $9,300. This shows the investors from YC to Fidelity in Series I, the round right before. This green shows the return profile. So this shows how much return would they have made from a compounded basis. Green is good, red is not so good, okay? But what the second chart here is, this shows the S&P performance, the index of what it would have been done if you put it on public equities. In 2012, if you put $1 in, you have gotten 30% return compounded from 2012, right? And then obviously this gray column shows the percentage difference, how much outperformance versus the stock market. Okay. So basically, what it means that from Instacart's IPO in 2012, when they came out with this crazy idea, which was, let's have somebody pick up your shopping for you from the supermarket and bring it to your house. So that means you put $1 in, the next year was $1.55. Then the next year is $1.55 times 155%. After that first round, they were like, no, 1 year down the road, they did a Series A at the same price. It was a flat round. Sequoia came in. And so they made 62% because the time distance between 2013 to 21 is shorter. Andreessen Horowitz came in for 29% in 2014 for Series B. Kleiner Perkins did Series C at $4,000, and then Sequoia came back at $6,000. In 2012, Y Combinator, you put money in, and then you see a company. 1 year down the road, they raised money at the same valuation. None of them did. Khosla, Kanan, and YC all said, we're not going to put a second check in. We don't believe in you. To that extent, to put another check in. This shows the lead investor. So obviously they could maintain their pro rata, so maybe they could put a small check in, but they put a large check in. But what's interesting to see here is that Y Combinator from the first check in 2012 came back in Series D in 2017. Sequoia also came back from 2013. They didn't need the next round, but decided to lead the Series D. Sequoia is acting like a multi-stage investor. They invested in the Series A, which was barely Series A. It's effectively a seed round pricing. But then they came back for the Series D for their late stage. So they are a multi-stage investor. If you look at Series F at a tender offer, DY doubled down. Then for Series H, they came in again in 2020. The check for Series H, it was minus 21%. And then Series I here, for this group of people, they lost about 51% of the value. The stock price was effectively $39,000 when they bought in, but eventually IPO'd for $9,300. So basically, if you are a VC and you join Instacart, let's just say a Series seed round, you could have been like, you know what? I think this company is amazing. I'm going to double down. I'm going to lead the next round. Right? You could have put a ton more money in money. Some VC investors put in more money and didn't do well. Sequoia came in and did okay. This Series I check was bad. Lost money, right? They came in Series D. They still make some money, right? It's an interesting perspective. For example, I'm part of a VC fund, and then basically we're looking at a portfolio, and then the initial investments that we had, they're presenting to us, and we're making a decision, do we want to reinvest in them again for the next round? What do we do with companies that are not doing well? They can wind down, hire, or cash out. Wind down is quite straightforward. The whole company sells off the assets, they pay back any debts, and they return any remaining capital to shareholders. Acqui-hire is the company buys over the team because they want to get the talent in that team. So they're not really buying the company for the company's products, they're buying the company for the talent in the team. And so we see that a lot in many different AI companies now. A lot of them are being acqui-hired because Microsoft are desperate for AI talent, and AI startups not doing well, they want to buy them back, give them a small outcome. And obviously there's cash out. So maybe the founders have basically, somebody mentioned earlier, like what happens if the startup gets to a certain point but never go for IPO, make consistent profit every year for the next 10, 20 years, then you can cash out, you can sell your stake back to the founders and say, okay, you're going to continue running the business for a while. Acquisition and merger is a common exit path. You sell the entire company for cash because they want to buy over and keep running the product. I want to share you two different stories. One story is about Instagram, the other one story is about Snapchat. So both these companies were offered the opportunity to be acquired by Facebook. Instagram was founded in 2010, and after 2 years of work, they were given a $1 billion Facebook acquisition offer. They only had 13 employees at that point of time. Everybody got very rich from this acquisition. He stayed there 2018, and in 2023, Instagram was making $20 billion of annual revenue. Kevin left in 2018, and then he recently launched an app in 2023, and then he closed it down this year as well. But Instagram is a guy who said yes. Snapchat was founded 1 year after Instagram in 2011. He was also offered after 2 years an offer, and he was offered $3 billion. He said no. At that time, he had 20 employees. Now the company is worth about $16 billion. You're like, was it right or wrong? Instagram, you sold it for $1 billion, straight away you get the money, then you work, you get paid very well, you grew much bigger. Snapchat is not that big, but you have control. Whether you're the type of founder who would have taken the offer, yes or no, and whether the board wants to sell, yes or no. Companies can choose to go public. That would be the true home runs or unicorns. And so this roughly is around $2 to $3 billion threshold. So in the US, they'll pay attention to you if you have about $2 to $3 billion valuation. So you have to be ready to be compliant. You need to choose the right market. Are you going to list on the US stock exchange? Are you going to list on the Indonesia stock exchange? Are you going to list on the Singapore stock exchange? The New York stock exchange started first, IPO'd in 2017 for $4 billion. And today they're now worth $26 billion. The classic IPO went on the New York stock exchange. This is Forrest Lee. He's a Stanford MBA. This Dick Nash is now the founder for Asia Partners and his team ringing the bell. Then the second company is GoTo. So GoTo did traditional IPO on the Indonesia stock exchange, not the US one, and it listed directly. They listed for $28 billion and dropped to $6 billion last year. This year in 2024, they're worth about $3 billion. Slight, but they went public on the Indonesia stock exchange. For Grab, they went public on a special purpose acquisition company. The difference is I'm a private company, an IPO. I auction shares to enter the public market to get money. A special purpose acquisition corporation is basically saying, I raise money from the public market to acquire a private company to bring onto the stock exchange. When I do an IPO, I'm auctioning my equity and highest bidder gets my price and then I go public. A special purpose raises money to acquire a private company to make it go public. The other one is a special purpose vehicle buying a company. But anyway, all you need to know is that these are three different Southeast Asia unicorns and they all went public in three unique ways. What you need to realize about VCs is that most VC investments don't work. This is an example from 2004 to 2013. 65% of companies generate less than 1x, 25% generate 1 to 5x, but only 4% generate 10 to 100x, which is what you need for a unicorn exit. Analysis by Edgerson Horowitz showed that if you look at VC power law, 6% in terms of quantity generate 60% of all VC returns in the industry. Half of this 50+% also lose money. So those are two different graphs with two different methodologies, but shows the same analysis, which is a very small number of companies make a large amount of money. You will see some very established young VCs. Fund 1 is based on relationships and thesis. Fund 2 is based on momentum, numbers starting to look good, but there's not much data. By Fund 3, there's a lot of data from the previous fund performance. LPs are able to say, okay, the reason why I'm investing in Fund 3 is because you did well in the previous 1 and 2 funds. VC fund managers. So I always tell people, emerging VCs are like founders. They build a company from scratch, which is a VC. When building a first fund, you plan to design your thesis. Do I make 20 investments or 40? Do I invest in a certain geography? Do I invest in America? Do I invest in Hong Kong startups? There's a bunch of theses you have here. Then you do fundraising, pitch people to put money in a fund. You close the fund, get everybody to wire the money, manage your relations with the LP over time. Now they understand the whole unicorn structure of it. The LPs provide about $99 million and the GPs provide about $1 million, which comes out to about $1 million total VC fund. The VC will earn about 2% of this million, so about $2 million for 10 years. For 10 years, they'll collect a $2 million check to run the VC fund. The VC will invest $5 million in about 20 startups, and one of these startups will generate a $1 billion exit, which creates a 200x return. 19 other startups are effectively rounded off to zero upon exit. As a result of that $1 billion exit from $1 billion deployed, the LP gets $99 million back, the initial quantum. They get 80% of the upside, and so they receive $820 million of returns. And then the VC gets their initial $1 million back, then they get 20%, and then they get a $180 million bonus at it. So this is the best case scenario of everything I described for you. A great VC fund that's able to source great companies, that have right judgments, support them, and exit them at the right time on the IPO. This is what the best case scenario looks like, which is why a lot of VCs look like superheroes. What's important to know is there are several terms used. There's committed capital, or like what's the size of the VC fund, $100 million, etc. Then there's a bunch of definitional terms, right? Paid-in capital, cumulative distributions, residual value, which shows the formula. But the most important thing for you to know is that in general, there are two definitions that people will hear about VC funds. They will say, what is your multiple on invested capital? And DPI, distributions to paid-in capital. I will explain it very simply. If we as LPs put $100 million into the VC fund, and this VC fund now has $1 billion of paper valuation, but nobody has exited yet. There's no liquidity event. The companies have not gone and IPO'd yet. So the paper value of all that stock is $1 billion. Then the multiple on investment is 10x. Does it make sense? The return is 10x. The distributions, the paid-in capital, requires a liquidity event to unlock it from paper to actual cash to flow back to me. How much did I actually receive back? So this is one of the big issues at Southeast Asia, is that there are a lot of VC funds that have high multiple invested capital, a lot of paper returns, but nobody knows if they're able to actually IPO and exit that capital and create a cash payout that flows from the startup on IPO to the general partner and back to the LP. So again, this is for you to learn what you don't know and for you to do research more on. What's really important for you to understand is that the time value of money is really important. If you make money over a long period of time, that's good. But if you make a lot of money over a short period of time, that's even better. On this y-axis is the multiple on invested capital. If I put $100 million and I get paper return of 10x, so the paper valuation is $1 billion. It takes me 10 years to achieve this. Then the net return is 26%. This is the benchmark top quartile VC funds that are mostly aiming for this kind of outcome. A 10x return in 10 years. That's your 26% outcome. Okay? And then obviously, if you can get a 10x outcome, but you do that in 5 years, then your net return is 58%. So something for you to be aware of.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.